Hi there, I'm Lindsay Biscaya. Welcome to Market Call. Brianne Gardner is on the show today. She's portfolio manager and senior wealth manager at Velocity Investment Partners of Raymond James. And she'll be taking your questions on North American large caps. This is how you can reach us. You can call us toll free 1-855-326-6266, or you can send us an email to marketcall@bnnbloomberg.ca. And Brianne joins us now. It's great to see you.
Yeah, thanks for having me, Lindsay.
Yeah. Okay, so let's start with kind of like a broader picture on the markets, because obviously we've seen them still moving higher generally of late. But you say the tone has become more cautious. What are you seeing?
Yeah, I think we've seen, markets still, as you mentioned, moving higher, but the shift is really a little bit now tilting cautious from an overvaluation standpoint. I think earlier, in the rebound we saw through March and April, investors were really willing to buy almost anything tied to AI growth and economic recovery. But now, after really a strong rally from the lows, markets are becoming a little bit more selective as valuations are rising, expectations are becoming harder to meet. And I still see this technology, AI related spending continuing to lead the market. Especially across semiconductors, software, data center infrastructure, and through, corporate profitabilities and where we see profitability happening in earnings. But corporate commentary, with its strong demand, still investors are no longer rewarding just the story alone. Companies are increasingly, needing to prove those earnings growth can keep pace with this enthusiasm around AI. So another important shift that we're watching too is the reopening of the IPO market, right? We've seen that happening big in the news. I think several large companies are preparing to come public again, especially after the government shutdown that sees some of these, which usually, reflects stronger investor confidence and still improving risk appetite. So while that can support sentiment, it can also absorb liquidity in the market and signal parts of the market are becoming a little bit more overheated after a rapid rally up like we've seen. Obviously, geopolitical risks are starting to dwindle a little bit. We are seeing this proposal hopefully see a finalization, and the markets are certainly reacting to that expectation. And also interest rates are also remaining a major driver on the direction of the market as well, especially with the recent headlines around the U.S.-Iran ceasefire framework. Right. Definitely helped alleviate concerns around oil prices and inflation.
What about Canada in particular? Because you say the backdrop for Canada remains relatively stable, but obviously today we're seeing that Canada now officially in a recession. Does that change your mind at all, or do you still feel as though we're in a pretty stable place here?
Yeah, I mean, you're seeing mixed reports. Some people saying we're not in a recession. Some people saying we are. I mean, I've been saying we've been in a recession, obviously for a while. You are seeing it, layoffs starting to happen a little bit more and more as I'm talking to business owners, on a large scale. I think the Canadian economy, though, banks are continuing to show resilience, even with the renewals of mortgages, even with interest rates where they are. Their balance sheets have been able to withstand that. And still the materials and technology, have quietly supported the TSX. So yes, I think, the pullback in energy will definitely have a impact on the TSX and the outlook of the Canadian stock market. If we see weaker economic data continue out of Canada, we have tilted our portfolios more overweight U.S. and international versus Canadian exposure, but are selective in still Canadian stocks that are still strong businesses. I do think you have to be more selective. So we're still optimistic in the next, 18 to 24 months and believe that this market, still has opportunities, but more of an active managers rather than chasing momentum. So focusing on really, quality businesses and that have durable earnings, as well as exposure to longer term themes, while also remaining, we do expect some volatility to continue at least both directions until we hit midterms in the fall.
For sure. Okay, we're going to take a quick break right now. We'll be back, though, with Brianne Gardner of Velocity Investment Partners, Raymond James, taking your questions on North American large caps. Here's how you can reach us. We'll be right back. Welcome back to Market Call. We've got Brianne Gardner on the show today answering your questions. So, Brianne, we're going to go straight to the inbox because we've got an email question, this one coming in from Brian. And it reads, may I have your guest's assessment on Google due to the recent big gain? So what are your thoughts on Google and where they sit right now? Alphabet.
Yeah, I think Google continues to be a great business, great stock, one that we own in the portfolio. I think at the start of the year, it was a little bit underrated compared to some of the other, Meg 7, Meg 5 stocks. But, they still have one of the highest quality businesses in the world and dominating really the search engine, the digital advertising, cloud computing space. Yes, it's had a run up year to date, up about 24%. They still engage in a wide range of opportunities, right? The software, the healthcare, transportation, other technologies. They have the Google Cloud, which has been doing extremely well. And I think what makes them particularly attractive is also today is that investors can really access these assets at a valuation, I still believe, that remains reasonable, right? If we're looking at upside potential, you're still seeing, analysts across the board looking at a buy or outperform. Yes, you're still getting about a double-digit upside from here, 11% with a price target of about $4.30 per share. So again, we continue to own this stock. Ranks a 9 out of 10 for us fundamentally, and I think that they had some regulatory scrutiny that can remain a potential risk for a lot of these tech giants. I believe that the market is still underestimating really Google's and Alphabet's ability to leverage their massive user base, their proprietary data that they do have, and I think that this stock still has some room to run. So we are still bullish on Google and Alphabet, and I really like this name, and we're going to continue to hold it.
Okay, we're going to go to the phone lines now. We've got Frank calling in from Kentville, Ontario, with a question for Brianne. Hi there. What's your question?
Hi. My question's on CIBC. I own it, but ever since the earnings came out yesterday, it's fallen $10 a share, much more sharply than the other Canadian banks. And I would just like to know why. And secondly, if it is a good time to buy it. I'll hang up and listen to your answer.
Okay, thanks for that question. Brianne, it is falling today. It's down almost 2% at the moment. What are your thoughts on how investors are kind of treating this latest earnings report?
Yeah, we don't own CIBC, but the bank is obviously still one of Canada's biggest 6 banks, and I would say most domestically concentrated of the group. Heavily tilted, obviously, towards Canadian consumers, Canadian residential mortgages, and far less on the U.S. or international exposure that a lot of the peers have, right? RBC, TD, et cetera. So I think that domestic concentration was really long seen as the biggest risk or the most exposed if the Canadian housing cracks. We're talking about potential recession. I think CIBC is going to be the bank that is going to feel that the most. And yes, Canadian consumers simply, haven't rolled over the way that, people have feared. But I think recent results we saw from CIBC, yes, have been strong. But I think that at this point where analysts, are structurally cautious on is for years that, have been caught offside by their execution versus their peers you compare it to. So RBC, which we do own, diversified core. TD is the U.S. retail re-rating story. Scotia, the Latin America bet. BMO, U.S. commercial cycle play. So I think analysts were too cautious on CIBC for years, and the stock has outrun their targets. They've been really right on the direction, but consistently behind on the level. So again, not a stock that we own. I like RBC over TD. So right now, I think with just a lot of risks around Canada, we would be staying away from CIBC at this moment compared to the peers.
Got it. So you wouldn't be buying on the dip, which was the second part of that question.
Correct.
Right. Okay. All right. We're going to move on. John is calling in from Montreal with a question. Hi, John. What's your question?
Hi. I'll move from buying on the dip to selling on the upturn. I'm retired. TD Bank, I bought in the mid-'70s. So I just want to ask Brianna, should I sell at this point for my gains, and especially if we do have a perceived recession or not? And what sector should I put that into if she would be kind enough? It represents about 15% of my non-registered account. Thank you.
Okay. Thank you. Brianne?
Yeah, I mean, there's a lot in there, but I would say, TD, still in the financial sector. Again, U.S. Retail heavy. They have Maine to Florida branches really there. And that U.S. tilt is really, I think, why the money laundering fine they had and that gap on the U.S. growth hit TD specifically while their peers ran in the past. But the story is now on the re-rating. And as, where is TD headed from here? I think that TD has done a good job year to date, up over 22, almost 23%. And, yes, targets have been on point for TD. I think, you're looking at upside. It has been overpriced right now. They're saying it's overvalued by about 5%. So for me, I would be taking my profits on TD at this time. I think a 15% weight in a portfolio is quite heavy. A lot of Canadians are overweight Canadian financials, especially the bank. So I do think that I would be taking my profits. And some other areas of opportunity I still like, materials sector, consumer staples right now, or even, broader range, some selective technology names. But I would be taking my profits on TD at this time.
Okay, back to the phone lines. Roy's calling in from Vancouver with a question for you. Hi, Roy.
Hello, happy Friday. Wondering about gold, just getting into the metals. As to any recommendation, anything that you guys are holding that would be good to start with in gold?
Okay, thanks, Roy. Brianne, what about gold for you? Is there any specific stocks that you like or companies that you're watching?
Yeah, I've been on here quite a bit talking about gold. I think it was like a year and a half ago. Some people were saying I was a gold bug, but I just saw the opportunity in gold. I'm not a long-term holder of gold. If there's money to make, I'll be in it. Otherwise, I'm out and find something else. But, right now, I still like gold. I also like copper. And I think that copper is catching our attention a lot right now. And we've been adding more of that to the portfolio. From a gold perspective, we own names like Barrick, Wheaton Precious Metals, some ETF exposure as well. Gold is, I think, no longer just an inflationary story. We're seeing central banks continue to buy gold. Governments are running large deficits. Investors are looking for assets outside traditional currencies. And at the same time, gold still works as a portfolio insurance, right? So whether there's concerns over geopolitical risk, debt levels, or even market volatility, gold tends to benefit when uncertainty arises. And we still expect a lot of uncertainty, at least for the next 6 to 8 months. Again, copper too, I like in the growth side of the equation, this AI, data centers, electrification, power grids, I think they require enormous amounts of copper, and that supply is struggling to keep up. So, gold gives us protection and diversification, while copper gives us, exposure to long-term economic and technology growth. So I think both are opportunities to have in the same portfolio at this time.
Okay, good to know. We're going to take a quick break now. We'll be back, though, with Brianne Gardner of Velocity Investment Partners at Raymond James, taking your questions on North American large caps right after this. Welcome back to Market Call. We've got Brianne Gardner on the show today, taking your questions. We're going to go right to the phone lines. Ben is calling in from Alliston, Ontario, with a question. Hi, Ben.
Hi there. Thank you very much for taking my call. I wanted to ask Brianne about GE Vernova. I know it's the stock has seemed to have gone down the last 4 days, probably about 10% or so. But I just wondered what your outlook is. Thank you very, very much.
Okay, thank you for that question. Brianne, GE Vernova, what do you think?
Yeah, I mean, we've seen it tread sideways a little bit through the end of April to May. I mean, has had a huge run up year to date, up over 50%. And again, GE Vernova still engaging in that electric power industry, right? So operates through power, wind, electrification, that power segment is really offers that design, manufacture, and servicing gas, nuclear, hydro, and STEM technology that does provide that critical foundation of flexible, stable, and reliable power. So, has had a great run and participated. You're still seeing analysts across the board, with a buy or outperform, a few on the hold at this time, but I still see there's more room to run for this stock. You're seeing, double digit upside from here of over 20%, 22%. We see analysts with a price target of about 1,215. So, 147. 12.15. Apologies. I was looking at the wrong one. So I think there's still room to run for that stock. I would be a little bit patient at this time. Even if you're looking to, some comparables, Boeing hasn't seen as much run up in that space. Yes, there's some other ones that have had a nice run up too, but on the back of 2025, the stock also did 99% last year. So I wouldn't be getting greedy with it. I'd be taking some profits off the table along the way, but I do still see a little bit more upside to run for this stock.
Okay, we're going to go back to the phone lines now. We've got Tony calling in from Sudbury with a question. Hi, Tony. What's your question?
Thanks for taking my call. My question's on Aecon Group. It's had a really good run in the last year. It's up about 137%. It's been a top pick on the show several times in the past. Mm-hmm. But since the beginning of May, it's been on a downward trend. From what I can tell, there's been really no change in the fundamentals of the company. So my question for Brianne is, would she recommend continuing to hold this stock or sell at this point? Thank you very much.
Okay, thanks for that question. Brianne, not sure what you think of this one. Hold or sell?
Yeah, it's not one that I own in the portfolio or that we own for clients, but still it's one of the better known ways to really invest in Canada's infrastructure build out, right? And Aecon really builds some of the large projects people use every day. So that's transit systems, nuclear facilities, utility infrastructure, and transport networks. The story has been improving even with the pullback in the stock. We saw revenue grow 18% last quarter and backlog reached a record 10.9 billion. So that does still show the company has strong demand across nuclear utilities and their transport projects. I think investors like to see is the exposure to long-term themes. So growing power demand, grid upgrades, infrastructure spending all support their future work. But, construction is still a tough business. Margins are remaining relatively thin right now, and profitability can be affected by labor costs, project timing, and execution. So I think that's why you're seeing the pullback in the stock as well. So while, I like the infrastructure theme, I prefer, a business with higher margins and more predictable earnings stream. So if I look across the board, you're seeing still analysts expect 15% upside from here. Mixed bag between, buying, outperforming, or holding. If this was me, I'd be holding at this time and looking for direction to see if this stock is going to go up or down. But again, with stress and concerns on the Canadian economy, I would be a little bit cautious on the short-term play for this stock.
Okay. Tammy now calling in from St. Albert, Alberta with a question for Brianne. Hi, Tammy.
Good morning. And I just want to say thank you, Brianne, for all your past advice. I just love how you present things, and it's been really valuable to me. So thank you. And my question is, I've had BlackBerry for a couple of years now, and it's on a really great run. And I'm trying to figure out if I should hang on or for the long term or get out or buy more. So if you can give me your thoughts on BlackBerry and its evaluation, I'd really appreciate it. Thank you.
Thank you. Yeah, it's an interesting one. BlackBerry hit new 52 high week yesterday. What's going on with BlackBerry? What do you think investors should do if they're holding it, and why is it running so much recently?
Yeah, BlackBerry is an interesting story. It has been muted for a while, had a lot of struggles, and now, starting to take off. So thanks for the kind words as well, Tammy. I think right now, BlackBerry has transformed their business from just a phone maker into a software company, and they're doing a really good job at that. They have their two engines, the QNX, which is their embedded auto software, and then their secure communications. So that's the cybersecurity for the governments that they've been doing. QNX is really the story right now. Their revenue grew 20%, 950 million royal backlog, which is great. That's locked in from automakers like Mercedes, BMW, Volvo. And really that turnaround is real. The company returned their revenue growth. Margins are improving. Cash flow is stronger. And their fiscal year 27 guidance came in above what the street expected. And yes, the stock has skyrocketed from the lows, even around those $4 to over $12 now. And that's really driven by these earnings beats. And this backlog that we're seeing. So, for now, I'd be watching. Is it now a pure momentum name where the dollars are still small and the growth is lumpy and expectations have run away? From an analyst perspective, I'd say the stock has blown through every single target, 1279 to, 74 versus a mean of 719. So that's a upside of 44% implied. So it's stretched quite a bit. They're saying, 44 to 50%, they're outside of targets. So analysts are, I would say, either badly behind this move or you might see a healthy pullback. Its run from past is what I think it's worth. So right now I'd be taking some profits off the table for sure, because I wouldn't be surprised to see a pullback in BlackBerry in the short term. But longer term, it looks like they've made a change around in the core business model of BlackBerry. So, it definitely has on our watch list, not one we own, but I'd certainly be taking some profits off the table right now.
Okay, good to know. We're going to take a quick break now. When we return, though, we'll take a look at some of Brianne Gardner's past picks. That's next. Stay with us. Welcome back to Market Call. We're going to go through some of Brianne Gardner's past picks now. So, Brianne, these are from June 16th, 2025, so just about a year away. Your first one was ATS Corporation, recommended at $42.33, now at $43. Well, it says $42.50 here, at total return of 0.4%. Are you still holding this one? What is it that you like about this?
Yeah, we still own ATS, and I think it's a name we're going to continue to watch closely. It has had quite a bit of volatility over the past year, but still basically build machines that help other companies automate production, right? So across areas like food, pharmaceuticals, electronics. The latest quarter showed businesses still stabilizing. Revenue came in at about 747 million, ahead of expectations, even as bookings and backlogs have softened. But they did miss earnings, and the reason was more about the mix and timing than the demand collapsing. So life sciences orders slowed after a very strong period. And ATS is also stepping away from some of their large automated projects that carried lower margins. So right now, the company is sacrificing a bit of a short-term growth, I see, to focus on better quality businesses that are going to improve the profitability over time. So I think that's why the market, is now paying much closer attention to margins, the execution under their new CEO, because ATS can stabilize their demand while improving profitability, and the story will become much more attractive. So we see about double digits, almost 18% upside from here, looking at a price target around $50 per share, ranks at 8 out of 10 fundamentally for us. And I mean, still, the stock has returned over the last, 1, 3, 6 months, double digits. And we still are happy about holding this stock.
Okay, next up is LTS Minerals. So this is when you recommended it, it was at $27.32. Now it's at $57.45, return of 110%, total return 112. Are you still holding this one?
Yeah, we are. And I like it still, royalty company. And I always hype the royalty names because, they're collecting payments from mining projects tied to copper, potash, iron ore, lithium. And why it's attractive is their margins. Really, they benefit when production grows, but without taking on the same operating costs, risks as some miners. So yes, you can buy a miner, but you're going to see a lot more volatility. You have more risk. So I'd rather take the royalty play. The portfolio is also becoming more diversified. The lithium royalty acquisition they did added more exposure to electrification and battery demand. They're also growing their renewable energy angle through their royalty platform. They have management that's targeting about 70 million in revenue by the decade end. And so for me, it's really an attractive long-term model because you get exposure to critical metals and energy transition themes through a more stable business structure. We still see a little bit of upside, 3 to 5% from here. But again, I think analysts will readjust targets as we start to see this momentum build. So still ranks at 8 out of 10 fundamentally for us. And again, we have seen, year to date, the stock up almost 40% on that. So again, still a stock that we're going to hold in the portfolio.
For sure. Last up is Salesforce. So when you recommended it was at $263.88. Now it's dropped down. It's at $192.24. So obviously the software sector has had a bit of a year so far. What are your thoughts on Salesforce now?
Yeah, everyone's wondering when we're going to see kind of this software play. Are we seeing software kind of bottoming it out and see this turnaround story? I mean, Salesforce or CRM, it's really the name we're monitoring closely, especially with the recent debate around AI and software spending, right? That's front and center. For those that aren't familiar, obviously Salesforce provides the software many businesses use to manage sales, consumer relationships, and service operations. The stock has been under pressure because investors are really questioning whether this AI boom will disrupt traditional software models. They did beat on earnings this week, though, but their guidance was a little bit weaker than expected. So the last quarter was steadier than feared, which is good. Revenue reached about $11.1 billion. Margins came in better than expected, which is positive, and they are accelerating their buyback. So all positive things. But the bigger story is on their Agentforce, their own AI platform, where customers are adopting and usage metrics that are continuing to improve. So yes, sentiment around the software is remaining cautious, but we still see Salesforce as one of the better positioned larger software companies that we can see. So we're monitoring the stock closely. If it falls below 160, we'll probably be thinking of rotating out of this stock, but we see upside potential of about 40% from here. So being a little bit patient on this one.
Okay, we're going to have to take a quick break right now. We'll be back, though, with Brianne Gardner of Velocity Investment Partners at Raymond James. She's taking your questions today on North American large caps. We'll be back in a moment. Welcome back to Market Call. We've got Brianne Gardner on the show today taking your questions. We're going to go straight to the phone lines. We've got Jacob calling in from Barrie, Ontario with a question. Hi, Jacob.
Hello. Good afternoon to both of you. Brian, I'd like to ask you about Couche-Tard. I'm sorry. Couche-Tard. It's been going down all this time. Is there any way you can help me out to see what's going on, or it's going to go up or down, or what? Thank you very much.
Okay, thanks, Jacob. Yeah, Couche-Tard, a little bit of volatility there. What do you think, Brianne?
Yeah, thanks, Jacob. We used to own Couche-Tard. I think remains a company that we definitely continue to follow closely. They operate those Circle K networks selling, basics, beverage, food, fuel, everyday essentials, and really the largest convenience store footprint in the world. I think what has always made the story attractive is their playbook, right? They keep growing through new stores, acquisitions, operational improvements, while still taking market share from smaller operators. The last quarter showed momentum is proving. We saw U.S. same-store merchandise sales were up 3%. Management said trends strengthened as the quarter progressed. I also like the food and convenience side of the business, especially if we're seeing slower growth across economies. It gives them more control over growth and profitability than simply relying just on fuel sales. So while it may not be the most exciting retailer and have had a little bit volatility, it has built a long track record of disciplined execution and steady earnings growth. So ranks a 9 out of 10 fundamentally from me. Mixed bags are seeing about 18% upside from here with a price target of about $93 per share.
Okay, thanks for that. Back to the phone lines we go. So Jacques is calling in now from Laval, Quebec with a question. Hi there. What's your question?
Good afternoon to you too. My question is for Brianne. I appreciate your info on many of the stocks. I'm talking about SES this afternoon, the secure waste infrastructure stock. I am a shareholder, and I would need an explanation why this stock is going down after we have approved as shareholders the merger at $24.75 with GFL.
Okay, thank you for that question. So secure waste infrastructure. Brianne, what are your thoughts on this company and the direction it's heading?
Yeah, not one that I own, so not specifically aware of all of the details of the merger, but certainly we follow the stock. I think they they operate waste processing, recycling infrastructure across Western Canadian energy industry. So it's essentially a behind-the-scenes business that helps producers manage wastewater environmental. The last quarter was actually quite strong. We saw EBITDA come in ahead of expectations, helped by stronger margins in their energy infrastructure business, solid performance in metal recycling. I think the company also raised expectations towards their higher end of their guidance, which is good to see, of their guidance range. And stronger oil prices definitely continue to support the activity levels in Western Canada. I think the bigger story is, as you mentioned, this pending acquisition by GFL Environments, right? So at this point, the market is focused less on the operating results and more on whether, my understanding, the transaction closes as expected. So maybe it hasn't finalized everything. Again, not sure on every details of that transaction, but I still would be a holder of this stock if as you mentioned, we're seeing a price side upside price target of about 15% from here. So,
Okay. Back to the phone lines we go. We've got a lot of callers today. We've got Nihal calling in from Toronto with a question for you now. Hi there. What's your question? Hello? Okay, we might have lost that caller, but I do know that they wanted to ask about Bank of America. I don't know the specifics of the question, but what are your thoughts on Bank of America as of late? Go ahead.
Yeah, we do own Bank of America, as well as Citi Group and Wells Fargo in the U.S. Have owned those before as well, but don't own either today. I think our U.S. financial exposure, again, through Bank of America, JP Morgan, BlackRock, I think BAC is really one of America's biggest banks, consumer banking, wealth management, trading. Last quarter was a blowout. Profits rose 17%, $8.6 billion. Best earnings per share in nearly 2 decades. Equity revenue jumped 30%, best trading quarter in 15 years. They also raised guidance. It's down from its 2025 peak as rates stayed higher for longer and money rotated out of banks. That's not a company problem. That's more of a sector and rate-sensitive story. So what would change our minds is a cheaper entry at this point in the stock, or see a pullback. I think the clearer rate picture or signals that are signs that the lending income growth is accelerating, and that's what I look at to rotate back in or to add to this stock at this point. I think there's 22% upside. That's really, still some room to run for this stock. Analysts are saying there's still potential price target of about $63 per share. So again, I like this stock, but I would wait for a little bit of pullback from an entry standpoint. I think it's going to continue to do well.
Okay, we're going to take a quick break right now. We'll be back, though, with Brianne Gardner of Velocity Investment Partners at Raymond James, taking your questions on North American large caps right after this. Here's how you can reach us. Welcome back to Market Call, again with Brianne Gardner on the show today, answering your questions. So we're going to go straight to the phone lines. Bob is calling in from Montreal with a question. Hi, Bob.
Hi, Lindsay. Hi, Brianne. Your thoughts on TELUS, the long-term hold, or if you have any other suggestions in the telecom industry space. Okay. Thank you.
Thank you for that. Brianne, what do you think on TELUS? Anything you like better in that sector?
TELUS, we've owned TELUS in the past, but don't own it now. I think I've traded it a few times, and everyone's looking for kind of a turnaround story in TELUS. People got worried about the dividend and whether they could keep funding it, and I know obviously Bell that was the same issue with them as well, and whether they could while carrying this heavy amount of debt from the network build. I think the last quarter was steady. Revenue was roughly flat, and reported profit well under restructuring. The underlying business, is what we're looking at. The real story is their cash and their dividend. Free cash flow jumped 19%, and the dividend yields north of 7%, and that draws out income for investors. Two things help their story. They're cutting capital spending now that the fiber and 5G build is winding down, and they may monetize the TELUS Health arm of the business to pay down their debt. So my read is that the stock has sat below targets for years and rarely catches up. Analysts have been consistently too optimistic on this stock. So for me, it's one we're going to stay away from for now. Obviously I still like the company. We watch it closely. But one I like better is Quebecois in that space instead of TELUS.
Okay, got it. We're going to move on. Jack is calling in also from Toronto with a question. Hi, Jack. What's your question?
Hi, Lindsay. Hi, Brianne. My question is regarding Citigroup. You touched on it a little bit before. How come it hasn't gone up the way Canadian banks have this past year, and whether or not a slowdown in the U.S. economy might hurt banks of this type? Thanks very much, and I want to know if she owns it or not as well. Thanks very much.
Okay, great question. Thanks, Jack. Yeah, you did say earlier you like Citigroup. Brianne, what do you think?
Yep, and we have, as I mentioned, owned Citi in the past, not at this exact moment. It's been, I think, to us, same thing, a turnaround story in the U.S. banks. Citi is America's fourth, I believe, largest bank. They have that global footprint as well, and have done a very good job, moving trillions in payments worldwide daily. The latest quarter was beat on their revenue, the best that they've had in decades. Earning jumps over 50%, 56%. Hit their profitability target ahead of schedule. And the story is, that years of ruthless, almost simplification, cutting staff, selling off foreign units, that is now finally showing up in the numbers. So how the U.S. banks differ, JP Morgan, which I mentioned that we do own, I think is the best in class diversified leader. BAC, we talked about rate sensitive, consumer deposit plays. Wells Fargo, more in the domestic retail banking, especially coming off of asset cap, and Citi is the global service turnaround. So each is a little different bet on geography and what's driving the cycle, depending on what else you have in your portfolio. I think the stock still trades below book value at the cheapest of the big four. And the re-rating story has room if really management keeps executing as they have. So, we see there's still about 16% upside from here, with about 80% rating it as a buy. So, I think the one thing for Citi is the interest rates staying higher are putting a little bit downward pressure on the stock at this time.
Okay, another caller from Toronto. This one is Kai calling in. Hi there. What's your question?
Hi, good afternoon. Brianne, my question's on Palantir. I own a little bit of it, and obviously got beat up pretty good over the last year. But after the latest quarter, it kind of looks like it might be catching a little bid. Has it bottomed out? Do you have confidence in Palantir, or is it one of the software casualties of the AI apocalypse? Thank you very much for taking my question.
Thank you. Yeah, up almost 9% today. What do you think?
Yeah, we don't own it now. We have traded it in the past. And while the business, they have been executing very well, valuation remains our biggest concern at this time. Building as, software, help governments, increasing deploying AI into day-to-day operation. The company continues to win, though, business on both sides of the market. So they have that strong adoption in the commercial customers and growing use of government and defense program. I think what stands out is that it's not just the AI story anymore, right? Palantir is proving it can turn that demand into real profits and cash flow. Latest quarter was exceptional, revenue growing 85%, supported by strength in both its commercial and government segments. I think the challenge is going to be valuation, right? As I mentioned, even after the recent pullback, the stock still trades at roughly 40 times next year's sales. So that leaves, little room for disappointment or error. So again, it's one I'd be cautious on. Again, we still like the longer term play and story of it, not one we own today. We're a little bit hesitant with the current valuation in this stock.
Okay, we're going to have to take another quick break right now, but we'll be back with Brianne Gardner right after this. Stay with us. Join us on Monday on Market Call. Teal Lind will be on the show. He's manager at Lind Equity Fund, and he'll be taking your questions on North American stocks. Okay, time now for some of Brianne Gardner's top picks. So Brianne, as usual, we'll go through these one by one. Your first one is Celestica. What is it you like about Celestica?
Yeah, stock that we own in our portfolio, and it's been one of the biggest beneficiaries of the AI infrastructure build out. Celestica helps build the hardware behind AI and cloud infrastructure, including network equipment, switches, data center systems, really used by these hyperscalers. You can see the nice run up stock has had over the past 5 years, over 5,000%. And the growth has been massive, right? Revenue jumped more than 50% last quarter as demand for this AI infrastructure and high-speed network continues to accelerate. So what makes this story interesting is that they're no longer just a traditional manufacturing company. They're moving into products that with better margins, stronger customer relations, and they also recently won a new packaging optics program with a hyperscaler customer. So that reinforces, how important they're becoming in the AI supply chain. That said, expectations are now a little high. The stock has re-rated aggressively as shown, and the story does depend on that. I still see upside potential, even with this AI spending staying strong, of about 30% from here with a price target of about $6.25. So a stock we're going to continue to hold.
For sure. Okay, next up is Circle Internet Group. You say this is one of the more interesting ways to play digital payments and stablecoins without directly buying crypto. Tell us more about Circle Internet Group for maybe some of the viewers who haven't heard of it.
Yeah, we have seen a pullback over the past few months in Bitcoin, and we wanted to take advantage of that play. And Circle was a great opportunity there through that February, March pullback. And since then, we did recently add Circle to the portfolio. And it's an interesting way, as you mentioned, to play that stable coin without directly buying crypto. So it's the company behind the USDC, and that's the world's second largest stable coin. They're used for payments, blockchain-based financial infrastructure. Right now, the key for them is interest rates. Circle earns most of its revenue from the interest generated on the cash and treasury reserves backing the USDC. So a higher yield environment is a tailwind. And as expectations for aggressive rate cuts have faded due to, short-term spike in inflation, U.S. rate cuts going down, the market has become more constructive on this stock, which is positive for investors. The underlying business is also still quickly growing. The USDC circulation rose about 30% year over year to roughly $77 billion. And what I like about Circle is expanding beyond just stablecoin into payment infrastructure and enterprise partnership. We saw recent news, companies like Visa, Deutsche Bank, Goldman Sachs, BlackRock, Shopify, DoorDash, all huge companies who are all testing their networks. So, I see 35% upside from here, which would be great for our investors, and a price target of about $145. So I am still bullish on this stock.
And last up is Dollarama. I'm just looking at the one-year chart for Dollarama now. It seems as though it's trading a bit lower than it was at the end of last year. What is it that you like about Dollarama right now?
Yeah, Dollarama, as you can see, has been quite volatile over the past year. We have seen a significant pullback, which has brought it back onto our radar, right, through that March-April pullback. And now starting to see a slight upward trend from a technical standpoint. I think they are one of the strongest long-term retail stores in Canada, selling low-cost everyday products in a tougher environment, which we might be headed into. That value proposition tends to become even more important for consumers looking for value, where their dollar can actually go further. So what makes the story interesting is there's their growth runway. They already have nearly 1,700 stores in Canada, but will still see room to expand meaningful over time, and their business is becoming more international as well, through their Dollar City in Latin America and expansion into Australia. They have the Reject Shop acquisition. So really this company and business, yes, has been become a bit more cautious recently because margins are facing pressure. But that's from obviously their store renovations and their Australian turnaround. But for us, I think this is still going to be one of the best operators in the retail space with strong execution, defensive demand, and a long runway for store and earnings growth. So I see potential upside of about 15% from here with a price target over $200 per share.
Wow. Okay. All right. That's all the time we have. So we're going to have to leave it there. Brianne Gardner joining us today on Market Call. Really appreciate your time, Brianne. Thanks so much.
Thanks so much, Lindsay. Thanks for having me.
Yeah, of course. Have a great weekend. And thank you for watching Market Call. We will see you next time. Trading Day is next.